Hello and welcome to today's video brought to you by Enigma Traders. Today we'll be discussing the pullback strategy, a popular technique used by day traders to enter trades at a better price. This is one of three common trading strategies for day trades, and the following two will be discussed in upcoming videos. The pullback strategy is based on the principle that the market tends to retrace or pull back after a strong move in one direction. By identifying these pullbacks, traders can enter trades at a better price and with a tighter stop loss. To identify a pullback, traders typically look for a clear trend, such as a series of higher highs and higher lows for an uptrend, or lower lows and lower highs for a downtrend. Once a trend has been identified, traders will look for a retracement or pullback in the opposite direction. The pullback zone can be identified using multiple factors including trend lines, moving averages, pivot points, Fibonacci retracements, and previous highs and lows. In this video, we will cover how to find zones using previous highs and lows and combine it with Fibonacci levels. First, let's start with finding areas based on highs and lows. Find previous highs where the market has reached before, and those represent areas of resistance, as it indicates that the market has difficulty breaking above this level. The opposite holds true for previous lows and support. It's important to confirm these levels by watching how the market reacts. When the market reaches a previous high and it's unable to break above it, it's considered a resistance level. And when it reaches a previous low and it's unable to break it, it's considered a support level. Once you have identified the areas of support and resistance, you can use them to identify potential entry and exit points. For example, when the market is approaching an area of resistance, it may be a good time to take profits or enter a short position. Conversely, when the market is approaching an area of support, it may be a good time to close your short position or enter a long position. Combining areas of support and resistance with Fibonacci retracements can be an effective way to identify potential pullback areas. Fibonacci retracements are based on the idea that the market will retrace a predictable portion of a move, after which they will continue to move in the original direction. The most commonly used Fibonacci retracements are 38.2, 50, and 61.8%. Once a trend has been confirmed, traders will look for entry points at key levels of support at those Fibonacci levels. To draw a Fibonacci level, you identify the high and low of the move and use the charting software to plot the levels. To start with the pullback strategy, first, you want to identify a clear trend. Second, find areas of support and resistance using previous highs and lows, and then you want to apply the Fibonacci retracement. Next, you identify the pullback zone. Look for an area between the key levels of resistance and support where the market is likely to retrace or pull back to. This pullback zone can be identified by looking for areas where the market is approaching the key level of resistance and where the Fibonacci retracement levels are located. Here you can enter a trade when both areas meet together. You enter the long position and place a stop loss right below the next fib level. Traders will also set a target for taking profit, typically at the next level of resistance or at a 1-to risk-reward ratio. As per every trade, traders should always backtest and paper trade a strategy before applying it to live markets. I hope you found this video helpful. Please subscribe and leave comments for any videos you'd like to see in the future. Thanks for watching.